It's happening. We're in the midst of a financial storm, a once-in-a-lifetime event that's got the world's most powerful central bank, the Federal Reserve, losing money. You heard that right, and it's been decades since this last occurred, back in 1916. Fast forward to today, and the Federal Reserve is on track to lose a whopping $100 billion in 2023, with predictions of even bigger losses, possibly $100 to $150 billion by next year. How did they manage to pull off this financial feat? Did they start a gambling YouTube channel, buy into the Coinbase IPO, or take a gamble on Dogecoin? Well, the answer is much simpler, and it's all about those interest rates. You see, since March 2022, Papa Jerome Powell, the head honcho at the Federal Reserve, has been on a mission to tackle inflation. His weapon of choice? Raising interest rates. The federal funds rate has now soared to 5.3%, historically sky high, and it's shaking things up. But why does this matter so much? Interest rates going up means it's more expensive for everyone to borrow money, from everyday folks like you and me to big corporations and the government itself. Now, that's a double-edged sword because it's not just the cost of borrowing that's spiking, it's also the interest cost on America's debt. Let that sink in. The national debt has ballooned by nearly 90% since the pandemic began. It's like maxing out your credit card and then some. But here's the kicker, we've been using it for both rainy and sunny days. So, let's talk numbers. The national debt is currently a jaw-dropping $33 trillion. It's the highest it's ever been. Now, economists are split on what to do about this colossal debt. Some say if we don't start paying it down, it's unsustainable, and future generations will be stuck footing the bill. Others argue that it's all just a numbers game, a fancy accounting trickery, a way for the US government to keep track of how much it's added or subtracted from the economy. Imagine you owed rent, but you could just backspace the number to 0 on your computer. Would you worry about it? Now, the Federal Reserve, the big player in this financial theater, holds a significant chunk of this debt. They've been buying treasury bonds and mortgage-backed securities as part of their monetary policy. Think of it as them managing the economy's temperature. When they add to their portfolio, the economy grows faster. This is called quantitative easing. They did a whole lot of it from 2020 to March 2022, and boy, did it make everyone feel like a financial genius. But here's where things get tricky. The Fed decided to reverse course. They started selling off these assets, known as quantitative tightening. And guess what? They're not adding new assets at these higher interest rates. So, their financial portfolio is out of balance. The result? They started losing money. The Fed made $88.4 billion in net income in the first half of 2023 but paid out a whopping $141.8 billion in interest expenses, leaving them with a loss of around $53 billion. If this continues, they could double those losses by year-end. Why does this matter to you? Well, brace yourselves because here's the kicker, the Federal Reserve sends money to the US Treasury when it's in the black. It's like your savings account feeding into your everyday spending account. But when the Fed loses money, there's less to remit to the Treasury. And that's where it gets real. Less money for the Treasury means less funding for crucial programs, from Social Security to infrastructure. Now, let's look at Japan, the debt giant of the world. Japan's debt-to-GDP ratio is mind-bogglingly high, and they've been running deficits for 3 decades. So, what's different? Demographics, fiscal policies, work culture, and global dynamics all play a role. But the US isn't Japan, and our situation is unique. So, what's the takeaway here? The national debt isn't necessarily a ticking time bomb. It's not a burden that future generations will inherit directly, but it's also not monopoly money. We can't just print our way out of trouble. Finding the right balance between addressing the debt and investing in our future is the challenge. In the short term, all eyes are on the Federal Reserve. This week, they'll decide whether to adjust interest rates. Keep an eye on this because it could impact your borrowing costs and your investments. And that's the story of how the Federal Reserve started losing money and why it's more than just an accounting quirk. Don't forget to smash that like button, subscribe if you haven't already, and share your thoughts on the national debt in the comments below. Your voice matters in this financial debate. Like and subscribe to our channel now.